The S&P 500 is currently witnessing the formation of this rising wedge here where every rally is actually slowing down in momentum. And so in today's video, we discussed whether the upside or downside potential is currently bigger here for the S&P. We're about to have a look at the most important macroeconomic drivers of the S&P 500 to actually evaluate whether we're about to see a breakout to the top or to the bottom. By the way, if you like this approach of taking a look at the past cycles and learn from them, please make sure to subscribe to our channel and like the video so you support us here on our channel, and also don't miss future update videos. Thanks for your support. Now let's have a look at the S&P 500 weekly chart. The S&P 500 is obviously one of the most important stock indices in the US, and there is an interesting correlation between interest rates, the PMI, the Purchasing Managers Index, and the global M2 money supply here in the form of year-over-year percentage change. And so what you do see here is actually an interesting correlation between the M2, which is always coinciding to a rising PMI, or in other words, you do have this positive correlation. And obviously, when we do see interest rate cuts, we do actually tend to see that the money supply is increasing. And when it's rising, we too tend to see the end of this increasing money supply, beautifully represented here in the lower chart by this contraction that we've seen. And as a result of this money supply's contraction, we do always see the PMI, the Purchasing Managers Index, which is measuring the economic activity in the US, you do obviously see it to slow down as well. And what we've seen here in 2020 is actually quite interesting, because we are currently seeing similar things happening to the S&P 500. We have seen this consolidation right here. We are currently seeing this consolidation right here as well at the PMI. We have seen those interest rate cuts. We are currently seeing those interest rate cuts as well. It does really look like we are seeing history repeat at this point. It does look like we are rhyming again. But obviously it's because of this cyclical nature that we're always having. And we are quite pessimistic on the year 2026. Which means, in other words, we do believe in a deeper global crash because of empirical evidence, because of cyclical evidence, because of historical evidence. The last few times we have seen those interest rate cuts, we have always seen that happening for a reason. And the reason was a slowing down PMI. The reason was that we have seen the money supply being contracted to a point where there was just a reversal here necessary. And you do see that this corona crash, actually from the money supply perspective, was exactly in the middle between this top and this bottom. And we're currently seeing similar things playing out again. We are also not at the bottom and at the top, quite likely. We do believe that due to those underlying problems that we are seeing, it is quite likely that a deeper global crash could actually occur in 2026. We are seeing underlying weaknesses, for example, in the form of rising unemployment, but also obviously inflation is picking up. And we do believe that we are seeing those interest rate cuts for a reason. We do believe that the PMI could actually crash before we are actually able to see this recovery, probably again by QE, and then we might also see this deflationary crash first happening to the global M2 money supply before we see this actually expand again due to further interest rate cuts, and also this Fed balance sheet expansion, which we are also first hand seeing the beginnings of. And we have seen similar developments here in 2020 and 2019, and those reversals at the Fed balance sheets are obviously also happening for a reason. If you now have a look at the European Central Bank, the ECB, you do still actually have a contraction here, even though we do see this actually to consolidate right now. But if you have a look at the Central Bank of China, you do see that we have actually had this liquidity flowing into the global markets for quite a while now. And so overall, we do believe that liquidity is actually, liquidity itself is actually slowing down, but we are seeing this obviously being currently counteracted by those Fed policy cuts. And so it seems to be not the right stance to argue that global liquidity is about to rise whenever you do see interest rate cuts. In fact, most crises actually happen after we've seen those cuts. The 2020 crash is just one example. We've seen similar things happening here in 28 with the great financial crisis. And so it obviously does not seem reasonable to be bullish just because of interest rate cuts. They do always happen for a reason. And that's exactly what we have actually seen here in 28 and what it currently seems to mimic quite beautifully. Obviously, we're quite conservative. We do, at the same time, however, do believe that this is not necessarily the ultimate end of this bullish rally. In the short term, everything can happen. We might just see this another bullish breakout due to, for example, another liquidity injections, as actually happened here in 2019, where we've seen this actually coincide to the beginning of this Fed balance sheet expansion that we've seen. You have seen that this liquidity, which was injected, actually was able to form this another high here at the S&P. But overall, we are quite conservative due to the concerns that we've just told you, due to the cyclical evidence, historical evidence, the PMI, the interest rates that are being cut. But yeah, that's it. I think it's quite clear at this point. I hope you enjoyed the video. It was informative to you. If it was, please make sure to subscribe to our channel and like the video so you don't miss future videos, and also support us for our work here on YouTube. Really appreciate your support and your effort in this community. And so let's see what's happening here to the markets. Please comment what you think is going to happen next to the S&P. Yeah, and then we'll see what happens in the next few videos. Bye bye.